Stop what you're doing. Look around you. Imagine everything you own, your house, your family savings, your entire future, disappearing in less than a week. Not because of a war, not because of a fire, but because of a single secret decision made by one man in a New York City office. In the glittering 1920s, America thought it had figured out how to get rich forever. Everyone was a winner until he decided the party was over. We're going inside the hidden truth of the 1929 Great Crash. We will name the man who played the biggest, most dangerous game in history, and we will follow him moment by moment as he pressed the button that blew up the global economy. You won't believe how much money he made while the rest of the country fell into poverty. Stick with us, because the most shocking part of this story isn't the crash itself, but the final, desperate actions he took years after the disaster. Before he was called the Great Bear, they called him the Boy Plunger, and he saw the future of the market with a cold, terrifying clarity. He wasn't a banker, he wasn't a politician, and he certainly wasn't a hero. He was a gambler, a genius, and the single man who knew exactly when and how the party was going to end. Jesse Livermore was born into a simple New England farm family, but he hated the dirt. He hated the endless, predictable labor. He wanted speed, risk, and money. At just 14 years old, he ran away and got a job as a, quote, boy at a brokerage in Boston. His job was simple: write down the stock prices as they flew in over the wire. But Livermore didn't just write them down, he watched them. He saw patterns the millionaires missed. He saw how human greed and fear made the prices jump and crash. He had a photographic memory and a mind like a steel trap. He didn't use a calculator, he didn't need a newspaper. He would quietly calculate where a stock would go next. He started placing small, secret bets in the bucket shops, illegal trading dens where people bet on stock prices without actually buying the stocks. Listen to this. The famous bucket shops had to ban Livermore as a teenager because he won money so consistently. Imagine being so good at gambling that the casinos wouldn't let you play. He was so sharp, so consistently right, that he was literally taking all their profit. They threw him out and told him never to come back. Forced out of the small shops, Livermore had to go to the biggest gambling hall in the world, Wall Street. By the time he was 20, he was famous. Not famous for being smart, but famous for being deadly. His strategy was simple but brutal. When everyone else was screaming, "Buy, buy, buy," because they were scared of missing out, Livermore was watching the silence. He called himself a speculator, not an investor. An investor buys a stock and hopes it grows. A speculator bets on whether it will go up or down. He mastered the art of the short sell, a scary, high-stakes move where you essentially borrow a stock you don't own, sell it immediately, and then hope to buy it back for a much lower price. If he was right, he pocketed the difference. If he was wrong, he was ruined. Livermore didn't just get rich, he learned how to move the market. He didn't follow the trends, he created them. He established his genius and his massive influence over the 1920s by betting on and against giant companies. They called him the King of Copper when he cornered the market on that commodity. He was a force of nature, a man who proved that money wasn't made by work, but by knowing when the masses were wrong. He was the first modern financial superstar, and soon his next, greatest, and most destructive bet was waiting. In the speakeasies and on the streets of New York, people weren't asking, "Should I buy stocks?" They were asking, "Which yacht should I buy first?" The year is 1928, and America is a party that never stops. Electric lights are blazing, jazz music is screaming. Everyone is driving a brand new car and listening to the radio. This isn't just prosperity. It's a fever, an absolute delusion that the rules of gravity no longer apply. People didn't just have faith in the future, they had faith in the stock market. You see, the stock market wasn't just for rich men in top hats anymore. Your barber, your cleaning lady, the shoe shine boy, they were all in on it. They saw their neighbors getting rich overnight and thought, why not me? It was a massive collective dream of easy money. And how did they buy these stocks? Well, they used a terrifying invisible weapon called margin. Imagine you want to buy 100 shares of a company worth $10 each. That should cost you $1,000, right? But in the Roaring Twenties, you didn't need $1,000. You could put down just 10%, $100, and borrow the rest from the bank. That's margin. This meant you could buy 10 times more stock than you could actually afford. This practice fueled the market like gasoline. Prices soared to dizzying heights, but the entire structure was built on debt, on borrowing money that didn't exist yet. It was like building a skyscraper out of thin air with one small gust of wind ready to knock it down. But here's a shocking detail. The amount of money borrowed to buy stocks by 1929 was more than the entire value of all the paper money in circulation in the United States. Think about that. The financial world was one giant, beautiful balloon inflated only with promises and debt. Jesse Livermore, the man who saw patterns, was watching this madness. He didn't see success, he saw the ultimate opportunity. While the whole country was dancing, he was quietly sharpening his knives, preparing for the most lucrative and most hated trade of his career. He knew the dream had become a deadly illusion, and he was ready to bet everything on the nightmare.
Wait a second. If you're still listening right now, it means you've felt the rush of the Roaring Twenties and you know a storm is coming. That excitement is exactly what drives these deep dives. Don't miss the moment the bubble bursts. Take one quick second, hit the like button and subscribe to the channel. Your support is the fuel that lets us keep uncovering these hidden stories. Now, let's get back to the debt mountain, because the clock is ticking.
The bank manager smiled as he handed over the loan, but every dollar borrowed to buy stock was a tiny, invisible tripwire waiting to be snapped. This wasn't just gambling. This was a countdown to catastrophe. By 1929, the entire nation was drunk on borrowed money. It wasn't just individuals using margin. Huge investment trusts, powerful companies were doing the same thing. They were creating companies whose only purpose was buy other companies' stock, all with loans. This created what historians call a pyramid of leverage. Imagine a massive, towering stack of dominoes. The first domino is the little loan your barber took out. The next is the loan your banker took out to cover your barber. The next is the massive loan a big investment firm took out to cover all the bankers. Each one is leaning precariously on the one before it. The banks were happy to lend money for this because they were making a killing on the interest. The interest rates for these, quote, call loans, the money used to buy on margin, got higher and higher. It was a vicious cycle. The higher the stock prices went, the more people borrowed, which pushed the prices even higher. This created a fragile bubble. And here's where the danger really lies. The banks could demand their loan money back at any moment. They could place a, quote, margin call. If your stock dropped even slightly, the bank would call you and say, you need to put up more cash, or we will sell your stock right now. Since everyone was leveraged, a small drop in price could instantly wipe out thousands of people who were forced to sell. The most surprising fact about this mountain of margin, the Federal Reserve, America's central bank, actually saw how dangerous this leverage was. They warned banks to stop lending so much money for stock speculation. But the banks just ignored them. They were making too much profit to stop. So, as prices hit their absolute peak in September 1929, the market was sitting on a mountain of debt, waiting for the first tiny tremor. Jesse Livermore knew exactly how much debt was supporting the entire structure.
He knew that he could just trigger a small fear, the banks would ring those margin calls, and the dominoes would fall not by the thousands, but by the millions. This widespread borrowing had delivered the entire American economy right into his hands.
While the crowd cheered the dizzying heights of the market, Livermore was quietly selling off his millions, like a captain abandoning a sinking ship. It was September 1929. The stock market had just hit its highest point ever, a peak so sharp it felt like a mountaintop made of glass. Everyone was celebrating. Analysts were saying the market had reached a permanently high plateau. But Jesse Livermore wasn't celebrating. He felt the atmosphere change. For the rest of America, the rise in numbers represented prosperity. For Livermore, they represented exhaustion. He knew that after a run that long and that steep, the market had used up all its buyers. There was nobody left to push the prices higher. Only one direction was left. This was the moment of his great decision, his turning point. He began to sell, not just a little bit, but everything he owned that was tied to the boom. Slowly, silently, he liquidated his massive portfolio of stocks. He converted his assets into cash, preparing for the crash he knew was coming. He became the whisper of the bear being the term for a seller who profits when the market falls. He tried to warn a few close associates. He quietly told one partner, "The top is in, get out." They looked at him like he was crazy. How could he walk away from the greatest money-making machine in history? This brings us to the shocking truth. The market's biggest optimists actually mocked him as gloomy Gus and called his warnings unpatriotic to the booming economy. Think about that. To suggest that the market might fall was seen as an attack on America itself. The financial leaders were so blinded by greed, they treated caution as treason. But Jesse Livermore didn't care about being popular. He didn't care about patriotism. He only cared about being right. Once he had cashed out his long positions, he started the most terrifying phase of his plan. He started short selling, on a scale the world had never seen. He was building up his final catastrophic bet, a wager of tens of millions of dollars that the American dream was about to violently shatter. He wasn't just predicting the disaster. He was putting the ultimate weight of his fortune on the belief that he could trigger it. His silent strategic move was the first crack in the foundation.
On the morning of October 24, 1929, an urgent telegram arrived at the most powerful brokerage house, containing a single instruction that would change history: sell. This is the day the panic started. It wasn't a sudden, massive collapse. Not yet. It was a tremor, a tiny, deliberate push on that massive stack of dominoes. The day was known as Black Thursday. Up until this point, the market had been wobbling, but it hadn't broken. But when a massive sell order hits the market, especially one from a figure as influential as Jesse Livermore, it sends a shockwave. You see, Livermore had been strategically building his short positions for weeks. Now he chose his moment. The market opened, everything seemed normal, and then the floodgates opened. It wasn't just Livermore selling, of course, but his huge, concentrated sell-off served as the catalyst. It was the sight of those first massive blocks of stock hitting the floor price instantly dropping that made the other big players nervous. They didn't know who was selling, but they knew someone big was walking away. And in a highly leveraged market, fear spreads faster than good news. This leads us to the surprising fact. The first big drop on that day was likely triggered not by small investors, but by an oversupply of stock from just a few large nervous investment trusts, with Livermore's order acting as the final massive weight. These trusts, the very ones built on borrowed time, looked at Livermore selling and panicked, deciding they had to beat the others to the exit. As the prices tumbled, the phone lines to the banks exploded. Margin calls began ringing out across New York. People who had invested $10 now owed the bank $100, and their stock was worth only $50. They had to sell immediately to cover the debt. Livermore's move, his telegram, was the match. The mountain of margin was the gasoline, and suddenly the whole system ignited. Within hours, the market had lost 11% of its value, and the brokerage houses looked less like businesses and more like battlefields. Livermore had achieved his narrative goal. He had initiated the panic, and there was no turning back.
The ticker tape, a machine designed to report prosperity, could not keep up with the speed of the fear, spewing out news of ruin hours behind schedule. This was Black Thursday, October 24th, the day the polite, high society world of finance dissolved into pure animal panic. Imagine the floor of the New York Stock Exchange. Normally, it was a loud place, but this day, it was a roar. It was the sound of 1,000 men screaming, pleading, and trying to sell stocks that nobody wanted. Brokers tried to fill orders, but every time a price dropped, another cascade of margin calls hit, forcing more sales. It was a downward spiral that no one could control. The market systems simply failed. The mechanical ticker tapes were overwhelmed. They were designed to print stock prices, but the volume of selling was so immense that the tapes were running 2 hours late. Think about that. Investors didn't even know the current price of their stocks. They only knew the price from 2 hours ago. They were flying blind, steering a ship into a hurricane based on old reports. And the pressure was unbelievable. People who thought they were rich in the morning were totally ruined by lunchtime. Crowds of people who had rushed to the financial district gathered outside the exchange, silent and terrified, waiting for any news. This is where the human toll became terrifying. People got so desperate that brokers were collapsing from exhaustion, and some traders started throwing themselves out of skyscraper windows. The financial ruin was so immediate and so absolute that some saw no other way out. It turned the street into a nightmare. But the finality hadn't come yet. The market was broken, but it hadn't completely died. This is the moment the powerful men of finance made their stand. The goal of this day was to prevent total collapse, to keep the lights on and the panic from spreading completely out of control. The breaking point had been reached, but the ultimate disaster was still a few days away. The richest, most powerful men in America gathered in a grand room, deciding to risk their fortunes on a daring gamble to save the stock market. It was late afternoon on Black Thursday. The market was plunging so fast, people feared the entire financial structure of the United States would vanish by nightfall. The government wasn't equipped to deal with this, so the responsibility fell to the titans of private finance. Down in the offices of J.P. Morgan and Company, the titans met. This wasn't a corporate board meeting, this was an emergency war council. Imagine the men in that room, the heads of the biggest banks, insurance companies, and investment funds in the world, silent and tense. Their goal was simple: restore confidence. They had to prove the market had a floor and that the rich hadn't totally abandoned the poor investor. They came up with a plan that sounded impossible: pool their own money, a massive reserve of capital, and use it to buy huge blocks of stock at above market prices. This would create artificial demand and stop the free fall. The man chosen to execute this daring rescue was Richard Whitney, the vice president of the stock exchange, a man known for his dramatic flair. This is the surprising moment. One banker famously bought shares of U.S. Steel at an inflated price on the floor, hoping to inspire calm. It worked for one day. With a stiff back and a calm voice, Whitney walked onto the chaotic trading floor and placed bids for major stocks at prices far higher than anyone was selling. He bought 1,000 shares of U.S. Steel, a national giant, at an astronomical price. The sight of the powerful Richard Whitney, seemingly unafraid, spending the collective millions of the world's richest men, brought the chaos to a screeching temporary halt. For a few glorious, desperate hours, the prices steadied. The bankers had achieved their narrative goal. They had bought time, and they had convinced millions of Americans that the worst was over. But remember the man who started it all, Jesse Livermore. He watched the rich men play their heroic part, and he didn't blink. He knew the rescue was fake. He knew the debt was still there. And he knew that a temporary hope was just the delay needed for the final, devastating crash.
The day the market stopped falling and simply crashed, the sheer volume of despair was so great it sounded like a roar of a dying beast. The temporary calm bought by the bankers on Thursday lasted only until the weekend. Over those few days, millions of Americans absorbed the shock of Black Thursday and realized they were still deeply in debt thanks to the mountain of margin. Hope faded, and a cold dread set in. By Monday, October 28th, the fear was back, bigger and louder than before. On that day alone, the market lost another 13% of its value. The bankers, exhausted and out of ammunition, tried to step in again, but this time nobody listened. Their rescue fund was running dry. Then came the inevitable. Tuesday, October 29th, 1929, Black Tuesday. This was not a panic. This was a stampede. When the opening bell rang, the market was immediately flooded with desperate sell orders. This time, there were no heroic bankers to save it. The system was eating itself alive. Prices dropped so fast, so universally, that even the most conservative stocks plummeted. Everything was for sale. Nothing was buying. The day saw the largest volume of trading in history up to that point, over 16 million shares traded. But every trade was a testament to ruin. The market wasn't just digesting. It was wiping out years of savings and generations of ambition. This massive final collapse was the revolutionary aspect. It signaled the definitive end of the American post-war boom. The truly shocking fact about the ultimate crash is this. It took over 2 years for the New York Stock Exchange to finally clear the backlog of paperwork from the panic selling of Black Tuesday. Think about the sheer scale of the collapse. Brokers physically couldn't process the orders fast enough. They had to work late into the night for months just to record all the financial ruin. As the day ended, the trading floor fell silent, not with calm, but with exhaustion and defeat. Livermore, sitting quietly in his private office, had won his bet. The market was broken. The American dream, for millions, had turned to dust. The mountain of margin was gone, and the ground was littered with the pieces. His great, destructive bet was complete.
While the world burned, the Great Bear was a millionaire 100 times over, sitting on a fortune won from the ruin of others. But was it worth it? Black Tuesday had just ended. The silence that fell over Wall Street was heavy, weighted with the loss of billions. But in one corner of that city, one man was experiencing a victory unlike any other. Jesse Livermore's devastating short bet, his wager against the prosperity of the entire nation, had paid off. His profit? In a time when $1,000 was a huge amount of money, Livermore walked away from the crash with an estimated $100 million. He had essentially cleaned out the pockets of Wall Street and the millions of small investors who trusted the system. He was the biggest financial winner in American history up to that point. But the moment of triumph was complicated. When he arrived home that evening, his victory felt hollow. He was not met with cheers and congratulations, but with tension and fear. Here is the shocking fact about his victory. Jesse Livermore's wife, seeing the police crowd around his house after the crash, actually thought a mob of angry investors was coming to lynch him. She didn't realize the police were there to protect him from the ruined crowds outside, not to arrest him. His success was so absolute and the public ruin so total that he instantly became the target of public hatred. Livermore knew the money was his, but he couldn't enjoy it. The air was thick with despair. He had always played the market like a cold, logical machine, but he couldn't escape the human reality of what he had done. He hadn't just made a profit. He had profited from the destruction of his own country's economy. This chapter sets his climax, his financial victory, set against the backdrop of widespread personal tragedy. He was a champion of the market, yes, but he felt the crushing weight of public blame. Livermore had proven his theory was right, but the sheer size of his win guaranteed that he would never truly be forgiven for being the one man who triggered the final disaster. The guilt, or at least the burden of the enormous fortune, had begun. The crash was only the spark. The real disaster was the invisible, crippling fear that spread like a plague from the city towers to the smallest farms. Wall Street was finished, but America's suffering was just beginning. The massive sell-off, initiated by men like Livermore and accelerated by the margin calls, didn't just wipe out stock values, it wiped out trust. When the banks looked at their ledgers, they saw that all the money they had lent to speculators was gone. Their assets had vanished into thin air. Suddenly, even banks that weren't directly involved in the crash were nervous. They stopped lending to businesses. They stopped lending to farmers. Credit, the essential fuel of the American economy, froze solid. This fear led to the terrifying reality of bank runs. If you heard a rumor that your local bank might close, you didn't wait. You rushed down to pull your savings out. But banks don't keep everyone's money in the vault. They invest it. If too many people show up at once, the vault runs empty. And here is the shocking reality of the systemic failure. Over 9,000 banks failed between 1930 and 1933, wiping out the savings of millions of ordinary American families. This wasn't just losing money on stocks. This was the total, absolute loss of every dollar saved, instantly plunging families into poverty. The result? The dominoes kept falling. With no credit and no money, factories couldn't afford to keep workers, stores couldn't afford to buy new inventory, farms couldn't afford to plant crops. Companies started shutting down. Unemployment soared from 3% to 25%. This wide-scale bank failure and credit freeze was the systemic failure that turned a stock market crash into the Great Depression. Livermore's bet was the trigger, but the fragile, debt-ridden system was the bomb. The nation's economy ground to a halt, sending millions into breadlines, unemployment lines, and onto the road, looking for work that simply didn't exist anymore. The consequences of that October panic finally reached every corner of the country.
The money was gone, the golden age was over, and the Great Bear knew he'd won the battle, but lost the war. The world would never forget the role he played. Jesse Livermore had his $100 million. He had proven, with brutal, terrifying accuracy, that he was the smartest man in the world's most dangerous game. But the world he won in was broken. The golden age of reckless, unregulated speculation was violently over, replaced by a decade of struggle. For the rest of the country, the tragedy of the Great Depression forced massive, revolutionary change. The government finally stepped in, creating new laws and safeguards. They created the Securities and Exchange Commission, the SEC, to police the markets. They passed laws to protect ordinary people from the kind of devastating leveraged debt that fueled the crash. And crucially, they created deposit insurance, so that if a bank failed, your life savings would never be wiped out again. These rules were the direct, lasting monument to the panic Livermore had triggered. But what happened to the man himself? He tried to keep trading, but the market was a different beast. It was heavier, slower, burdened by the new reality. And Livermore, the genius who thrived on reckless volatility, struggled to adapt. His personal life, always tumultuous, started to unravel under the immense pressure of his colossal and tainted fortune. Here is the tragic, surprising fact that closes his story. Despite his massive fortune from the 1929 crash, Livermore would lose all his money and eventually die a broken man, showing that even the market's master couldn't control his own destiny. The man who profited from the greatest collapse in history ended up destroying himself, proving that the market always gets the last word. The story of the Great Depression is vast and complicated, filled with many causes, but at the heart of the spark, in that single, fateful sell order, stands Jesse Livermore. His life is a high-stakes thriller, a cautionary tale that confirms the truth. In the world of finance, one brilliant, greedy, and ruthless man can indeed set the world on fire. He won the game, but the victory cost him everything.
And that is the shadow cast by the one man who broke the world, Jesse Livermore. He played the ultimate game, won the ultimate prize, and proved that the fate of millions could, in a single moment, depend on the ruthless calculation of one. The Great Depression was a period of incredible suffering, but it was also a crucible for change, creating the very safeguards we still rely on today. If you found this journey through history compelling, and if you realize now just how close the world came to total collapse, then hit that subscribe button right now. We dive deep into the real stories behind history's biggest turning points, and you won't want to miss what we uncover next. Before you go, let us know in the comments below, where are you listening from right now, and what time is it where you are? We love seeing how far and wide the reach of these stories goes. Thank you so much for watching this complete, in-depth historical narrative with patience and focus. We appreciate your time and your engagement. Until the next deep dive, take care.